we certainly know it's been a volatile start to the year. Everything was going well until the 27th of February, and then everything got upended with the war in the Middle East, markets swinging between cautious optimism and outright anxiety as all of those geopolitical tensions flare. We've obviously seen a big spike in energy costs and investors beginning to question whether the old playbook still works. For more than a decade, the formula was quite simple. Buy growth, stay invested, and let liquidity do a lot of the heavy lifting. But that is starting to change. So how do you build a portfolio that doesn't just survive the environment, but actually helps you navigate what is a very tricky few months, at least, in the markets? Well, joining me now is Wendy Myers, head of PSG Securities. Wendy, always good to have you on. And it's amazing how quickly the scenario has changed for this year. But I think we need to go back to understand how to go forward. So if we want to understand how to position your portfolio, let's just look at how offshore markets have performed since the financial crisis. If we cast our minds back to 2008, because post the crisis, there was a very clear investment regime or strategy that worked when investing offshore.
Yes, Michael, I agree with you. And, it's actually, for me, first of all, it's crazy to think that the financial crisis happened almost 20 years ago. But not just that, I think, it's fascinating to look at when a crisis happens, how the world responds to that crisis and how investors then respond from an investing perspective. So if you look at what happened after the financial crisis, I mean, that period of 2009 to sort of before COVID was really defined by extremely low interest rates, massive monetary stimulus. You can remember the US was using their balance sheet to prop up asset values. And then, of course, the digital transformation of the global economy. And that made risk-on assets far more superior to the traditional defensive or cash positions. And just remember that risk-on assets are those financial instruments with extremely high price volatility, but they've got the potential for very strong returns. And, these types of assets thrive in periods with investor optimism, especially where there's high risk tolerance and economic growth. And obviously in a low interest rate environment, that supports that. So, those investors that started investing, even if it's 10 years ago, and use those investment strategies that prioritize growth, technology, and US dollar denominated assets that really did outperform, especially those that shifted towards the high growth sector, and obviously leveraging some of the growth of the Microsofts, the Amazons, and then towards sort of post-COVID, now this new concept called AI and all these hyperscalers that people are starting to look at, that the AI industry needs. Yeah.
And if you look at where we might be heading, if you look at what Kevin Walsh wants to do, he certainly wants to shrink the Fed's balance sheet. He doesn't like the fact that you had this concept of the Fed put effectively underpinning those risk assets. But given the above, I mean, what do you think were the key strategies that positioned an investor to perform well during that particular period of low interest rates and excess liquidity in the markets?
So I think, to me, Michael, the standout strategy is definitely the one that delivered the superior returns is prioritizing the growth shares, as I've said, over value. So the Magnificent Seven is called that for a reason. I mean, they dominated that period. Certainly other tech firms, but the gain and the investment returns from the Magnificent Seven were really material. And those stocks belong to that growth segment. And they led the recovery because they benefited from low interest rates and they were able to invest in their technology. There was high innovation at the time. And effectively what they were doing is they were benefiting from new consumer habits. I mean, suddenly the consumer was not going to the malls as much. They were using e-commerce. And with e-commerce, you need cloud computing. So that obviously led to Amazon's growth and Amazon web services. So I think if I consider that strategy to be the most standout one, I think the second most notable strategy was reallocating a portion of capital from those defensive stocks that I spoke about. So think items like shares like consumer staples, healthcare, utility stocks, overseas, that concept is those companies that provide essential public services, think electricity, water, natural gas. And if you'd move money from those shares to these cyclical shares where the performance is directly correlated to the economic boom because of the low interest rate. So think of those companies that provided non-essential discretionary services, luxury goods, travel companies, car manufacturers. All of those investments would have done well for the investor because they would have benefited from that growth and risk on environment. And then I think the remaining items, Michael, the remaining strategies that would have worked shouldn't be new to your listeners. I think the key ones that stand out for me is buying dividend paying shares and making sure that those dividends are reinvested. Obviously, you'd need to target those blue chip companies that offer strong dividend payouts, have strong balance sheets and cash flow to protect it against any market volatility. So that obviously would have driven attractive income in that period. And as I've said, reinvesting those dividends because it's critical for investors to reinvest and capitalize on any market volatility at good entry levels. And then I think that the standout one for me, in addition to what I've said, is just continuously rebalancing your portfolio because you will remember that with the tech stocks gaining in that period, they would have exceeded your comfort zone of what that share allocation would be in your portfolio. So if you decided that tech couldn't be more than, say, 6%, 7%, because of the growth, you might find it was nearing even 10%. So active rebalancing in that time would have really stood you in good stead because you wouldn't have been too exposed as we come out of that period to those tech stocks, which now we're seeing a bit of volatility to those returns.
And you would have been able to then lock in the gains and recycle that cash back into other areas that would position you probably better now. So given that regime, it does feel like that is a regime that is in the past and is probably unlikely to return anytime soon. And we saw that with rising interest rates, team transitory, and who'll forget Jay Powell and the most famous mistake ever made. And now we have structurally higher interest rates. As I said, Kevin Walsh, potentially the Fed chair nominee, is being grilled at the moment, but it looks like he'll make it. He wants to shrink the Fed's balance sheet, maybe withdraw some liquidity from the system. It'll see whether or not the market will allow him to do that. But we understand what worked for those investors that were invested. Let's unpack how to tweak your portfolio to ensure that it lasts for the long term, as investors shouldn't have to do big changes, I think, to their existing portfolio.
Yeah, absolutely, Michael. I think the key first step to take is to review your financial goals. I can't stress that enough. I think it's important to know why you're invested because it validates the time horizon that you've defined for that period that you want to stay invested. And if you're, when you consider your time horizon, you need to remember, obviously, we always take a long-term approach when we view investing because that long-term period cancels out all the short-term noise. And really, the Middle East uncertainty at the moment is purely that driving the volatility is purely just noise. And over time, it obviously, it's smoothed out. Then I think just make sure that when you're looking at your financial goals, that these remain relevant. There could have been material changes to your risk profile or changes to your lifestyle, and you'd have to factor that in when you consider the financial goals that you are aiming to achieve. And then I think another point that's important is, I mentioned it earlier, rebalancing and diversifying within your portfolio. If we look at today, if it was me personally looking at my portfolio, I'd look to move slightly away from the sort of US bias that the post financial crisis encouraged us to be invested in. I think moving beyond US centric assets, because they dominate world benchmarks, is a good choice to do. I wouldn't say move away from them completely, but I would look to invest new money in Europe and emerging markets. I do think they're expected to offer better returns in 2026. I would certainly look to move beyond technology, and I would look at seeking out those undervalued, high-quality companies in Europe, the UK, or even Japan. And I think, just tweak your geographic exposure. But the key point I want to stress, Michael, is don't disregard the US. They remain a dominant player, and they will always be part of your portfolio, but maybe be conscious that you are not too exposed to them. I think targeting emerging markets is a good idea, especially if you select those regions with strong fundamentals. If you think China and India, and you select stocks in those regions that benefit from the AI demand, more so than just investing in passive emerging market index funds, because I think it can actually do your portfolio good. And when you consider your geographic allocation, I think just consider diversifying into stable, neutral regions from a currency perspective, like Switzerland. We are concerned around the US currency and its weakness. It's weakened significantly. Look at the rand strength. So we're finding that investors are starting to move to those safe havens that Switzerland offers from a strong and stable currency perspective, and even stocks in that Swiss region. And I would also think of looking at gold. Gold was an underplayer. It's been great for the last year. But if you looked at the post-financial crisis, gold underperformed significantly. So I would look at having at least 5% allocated to gold as a hedge against currency devaluation, and also as a hedge against inflation and geopolitical tension. Also consider REITs. They offer stable income in the period, and it's a good cushion to your portfolio performance. And then I think, Michael, the last few points that I would consider is your currency risk, like I've mentioned. Be realistic that maybe a weaker dollar is here to stay. So what do we do to position our portfolios to make them stronger? And then defensive stocks, as I've said, try and look at those healthcare and financial companies that offer strong balance sheets and low debt and good dividend returns. And then commodities and energy is really a flag on when the real economy comes back, you want to be invested in commodities, not just gold. You might want to consider copper, aluminium, because they really do cushion your portfolio when there is geopolitical volatility. And then I think finally, the critical part of investing, we've always said, is periodic rebalancing. Make sure you bring your portfolio back to your target allocation, like I mentioned earlier, and be comfortable that the portfolio construction is going to set you up for the next 10 years.
No, I think, there's some. I was just going to say there's some. There's some clear signs that a lot of the old assumptions that we had made, for example, around energy security and that the US would underpin that, have been upended with what we've seen through the Strait of Hormuz. So, I think we can't base future predictions on energy markets based on those old assumptions.
And I think also, Michael, what I was going to say is that if you have any doubt, you need to sit down with your financial advisor. I think in times of volatility, we've spoken about it before, your financial advisor will give you such great insights into how to, tweak your portfolio, but also to give you comfort that you actually invested well and positioned well for the long term. And that is really the role that a financial advisor can provide to you, calming you in amongst the storm of all the volatility.
Especially now, when we do see a bit of regime change in markets and what worked in the last couple of decades and what won't in the future, because one becomes wedded. We have all these behavioral biases and recency bias, and it's difficult to emotionally extract yourself from that unless you've got a professional advisor holding your hand and guiding you through it. If you had to leave investors with, and I know it's difficult, but maybe one guiding principle to build a portfolio that lasts the next 10 years, what would it be?
I think there's such a need for investors to focus on their portfolio construction. I think during times of volatile markets, it's so easy to lose sight of the importance of proper risk management. The world is transitioning to new sources of risk and return. So an investor as an investor, it's important to ensure you are diversified in your portfolio. You're not exposed to certain sectors. We've always said, technology's made some investors great returns, but it's not necessarily for the full long term. And also be conscious of a portfolio that's very biased towards the dollar, the US dollar. And we're seeing emerging markets, they deliver very strong results because they're negatively correlated to the US currency. So having exposure to Chinese technology firms will certainly help contribute to diversifying your portfolio returns and cushioning it for those disruption risks that are a function of these mega cap technology stocks that are, causing a lot of volatility. And because of the high exposure, if those investors hadn't reduced their exposure to these technology stocks to those acceptable levels, they would find their portfolios to be far more volatile than others. But I think as much as there seems to be a focus on emerging markets in Europe, just don't write the US off. I think there will always be dominant players in the US, in the markets, in world markets and investing. But just be conscious of the exposure that you have to them in your portfolio and understand that for now, if you want to make sure that you set up for the long term and for the next 10 years or so, you need to be conscious of limiting that exposure to an extent. And certainly I would encourage investors to look at investing new money into non-US markets. But that's my personal view.
Yeah. I tend to go along with that because of everything that you've just unpacked, because we were in a highly unusual regime ever since the global financial crisis. And we do see a concerted policy shift, if you just look at the direction of travel, to reverse some of that, which is leading to the dollar weakness, withdrawing liquidity, all of those things, over concentration, in a world that feels increasingly unpredictable as well. I mean, let's face it, who knows what's going to happen out of Truth Social and the president's Twitter account from one day to the next. I think the message is clear. It's no longer enough just to be invested. You've got to be diversified and well constructed and apply that kind of discipline and a willingness to adapt. I think that may matter more now than at any point since the financial crisis. So Wendy Myers, thank you so much, head of PSG Securities, as always, for some excellent insight into very turbulent markets here on Business Talk.
Great pleasure. Thank you, Michael.